All right. So welcome to our class this morning for risk and management session. We are hopeful that none of you would have a reset of this course. So we've taken our time to assist you. All right. Your duty is after everything you practice. You practice, but to teach you more strategies, how to approach them. Please mute yourselves. Mute yourselves. We don't have time. All right. Let's continue. So this Nexus Premium, right? Let's see what we've done. We are yet to do. And I told you we're going to do weeks, this number. So we're going to do retention. We've covered most of the areas. We're going to do retention. We're going to do what is partial retention over there? Number 12. Partial retention. We're going to do here 1, 22, 23, 24, 26. That's what we are left with. All right. So I'm going to explain them, and then I'll bring the past questions. That's so you can comprehend them. All right, so let's start. I'm taking off the second page because we finished with everything there. 27 is miscellaneous, 28 reinsurance, share insurance, 30 indemnity. So I'm going to take that off so that I can concentrate only there. You need a C- to pass, but you can score an A. It's easy if you you understand the strategies. So now, risk management. When we say that, when we speak about risk management, moment. When we speak on risk management, right? Risk. Management. We can say it's the process of what? Identifying loss exposures, right? Analyzing the loss exposures, selecting the appropriate risk management technique or method to address the loss exposures, and implement the appropriate technique and monitor to meet management objectives or to meet management risk objectives. So that is basically what we'll say about the risk management. What is the risk management process? What is the risk management process? This question every year it drops. Every year it features in the exam, the risk management process. I'm going to write this risk management as RM. Right? So the RM process, every year this question features in the exam. And students sometimes will fail. Sometimes they make it compulsory, other times they don't make it compulsory. So let's see what we can do. I don't know how they'll make it this year for you guys. But every year this question features in the exam. All right. So let's see. The risk management process, I've told you, you must have mastery over acronyms. It will really be helpful for you. Risk management process. We go with the acronym IASM. I'm writing it on the right, so watch. IASM. Acronyms will really be helpful to you in your studies, so try to master as many as you can. And after these things are not just for I'm writing to pass and my score my A or B minus or my F. and I'm going, no, it's really practical in life. So today I'm going to make more of what I'm going to teach to be very practical. All right. All right. So let's continue. So that's the risk management process. So IASM is the acronym I'm going to use to construct or prepare the risk management process. So I've told you some will be considering why I still load it on the YouTube channel, but you'll be ahead because I've done it with you. You could ask all your questions. I was able to answer them. I get in it. And it will help you to further continue your studies. All right. Now, risk management process. I'm going to the acronym IASM. So I'm going to detail the IASM. The first we're going to have is the I stands for identify the loss exposures. Identify, right? You identify the loss exposures. We discussed loss exposures yesterday in our first session, our session yesterday. So you identify the loss exposures. All right, let me write it here. So identify, when you say to identify the loss exposures, we have the types you have to identify, right? We have the types you have to identify, and we have the sources. Sources. Pay attention. The sources of the loss exposures. So what are the types we talk about? Remember, yesterday we talked about pure risk, right? And the pure risk, we use the acronym PEOPLE. So we have the types of loss exposure could be personal loss exposures, property loss exposures, and liability loss exposures. And they are part of the 30 areas your lecturer gave you. Property loss exposures, personal loss exposures, and liability loss exposures. So those are the types of exposures you're going to identify. I get it. So these are property loss exposures. What conditions, right? What conditions avail or expose a property to the loss? Because a loss exposure is a situation in which loss is possible, regardless the loss occurs. So what conditions, what situations expose the property to a loss? So you have to search out for them. What conditions expose the business to the loss of liability losses, right? So right now we learned that liability losses could even involve legal cases, legal suits. If you, I worked with an organization, and the organization, whenever the year is about to end, you find the client of the organization writing. It was with a team of lawyers, right? I was the PA to the managing partner because he was my friend, so I had to sometimes go to him and be with him in this law firm. So sometimes I'll be there and he'll be like, okay, I've received some reports from this company, this company, this company. And letters. What are the letters talking about? The letters are requesting the firm, right, to state to them or to notify them or to inform them of the pending cases. And the letters are usually from their auditors, right? The letters are usually from the auditors. So let's say the business is, the firm is, let's say Pan African Savings and Loans, which is a subsidiary of EcoBank, right? And their lawyers should write to them that they should present to them the list of cases and the liabilities the business has endured or the business has been engaged in, and whether or not, and the chances of the business being triumphant or winning the suits, and the chances of the losses and the amounts involved. I get it. Why? The accounting firm, sometimes you find it from KPMG, you find it from PwC, you find it from other firms. Now, the accounting firm wants to ascertain, right, the liability loss exposures on the business. They want to know which cases the business will not be successful, so that they can use it to in determining, they can make a provision for it in accounting. We call it provision. or in a financial report, we call it provision. They have to make a provision for it. That maybe by next year, this monies will not, the business will lose the suit. And they've even started what is called out of cost settlement, right? So the business is going to lose this money. So that liability loss is to help them to determine to help them to estimate, right, the degree or the quantum or the magnitude of the losses which the business will suffer, and they will include it in the financial statement as a provision. Mostly in accounting, we include them in the financial statement as a provision, right? Because it's a liability, so as a current liability, as a provision. So you have to identify all these loss exposures. So we have the personal loss exposure, you have the property. Personal loss exposures are unique to the organization or the individual. Property are the assets of the organization, and the liability, all the lawsuits, right, which they've been sued, the judgment on them, the compensation, the damages, whatever, which is linked to liability loss exposures. I get it. The court processes. So you have to, there are ways you can find them. Okay. Now, what are the sources, right? Or should I say sources? Or let me say, yeah, where can you find these loss exposures? You can find some. You can find these loss exposures, sorry, from, or let me put it as sources or methods, right? So that you can get it right. Sources or, yeah, sources will be fine. Or let me say sources or methods. All right. So we go in with inspection, physical inspection. Sources. That's how can you identify these loss exposures? How? We're talking about the types you are going to identify, but how can you identify them? We talk about um, um, physical inspections. We also speak about the balance sheet or the financial statement. Financial statement or the balance sheet. You can identify loss exposures in financial statement. I getting it. Loss exposures in financial statement. So let me say financial statement. You can identify loss exposure through interviews. Through interviews. When you have interviews with the staff, you can identify where there are particular losses somewhere. I get it. And the types of loss exposures also, there are many. We can also have crime loss exposure. We can have credit loss exposure. We can have financial risk or loss exposure. I getting it. So we can have it through the interviews, right? You can also have it through checklists. Checklists. So there are many, on and on and on. Those are all sources or methods of what? Identifying the loss exposures. How do you identify the loss exposure? Through inspections, through the financial statement or balance sheet, or the profit and loss statement. I getting it. Then we have the interviews. You can also identify through checklists. You can also identify through reports. You can also identify through let's say worksheets, right? Worksheet. If let's say you contract some, you outsource or you contract some external workmen or janitors or artisans or whoever to come and work for the organization. During the process or after they are done, you can examine their worksheets to know that there were some loss exposures there. And these are done by experts. For example, if you give me a financial statement to examine, I can tell you some loss exposures there. That is situations or conditions in the statement which are subject to losses. I get it. So they are exposures. Are we good with this?
Yes, please.
All right, let's proceed. I've been telling you people. All right. So, any questions so far? Okay, so I'm going to click this part because I'm going to be writing somewhere else. So I've spoken about the types. I've spoken about the sources or methods of the loss exposures. You need them. Now, the issue is that the exam question could even cater for only the types. There could be an exam question where the concentration can be on only the types, right? So look down here. Look down here. Look here. Look at number 22, liability loss exposures. Look at number 23, property loss exposure. They are the types. The types. And we have the personal, right? They are the types. We have the personal. That's why I said they are all combined. So when I take them, so a question can only concentrate on the types, right? So in addition to what I have done with my explanations, you should read them from your slides so I can get a better comprehension for that. And after the risk is a course students fail, right? Students usually fail because some of them I think is grammar, but it's not grammar. It is technical and you need to understand the concepts. All right. So those are the types. The 2023 are the types of loss exposures. And I've also spoken about the what's the name? The sources or methods, right? Where you can identify sources of identifying loss exposures. As we have some. I know it should be in your slide, so you can also read further about it. Now, I've given you the acronym. Don't forget. Who can remind us of the acronym for the process? The risk management process. Who can help us with the acronym? Hello. Who can help us with the acronym? IASIM. Very well, Laurentia. Don't forget it. I've told you, if you remember it, you can move quickly. IASIM. So the first I stands for what? Identify the loss exposures. And the loss exposures, we have spoken about the types. Let me move this guy here. We have spoken about the types. And the sources or methods. The types, we've spoken about the methods and sources. All right. Now the next is we move on to the S. I'm taking my time because this is quite technical. This is very difficult sometimes. And we'll solve past questions. The A is the next. The next is you analyze the loss exposure. So after identifying the loss exposure, the next is you have to analyze the loss exposure. I can't tell what your compulsory question is going to be. You analyze the loss exposure. Pay attention. How do you analyze the loss exposure? When you are analyzing the loss exposure, you analyze the frequency. You analyze the frequency. Right? The frequency and the severity. You analyze the frequency and severity. Frequency and severity. What is frequency? Now, sometimes the question could be this: define what is called risk frequency. And I've told you when the question says risk frequency, which other name or what other name can you use for risk frequency? Let me see whether you remember what you did yesterday.
Loss frequency.
Very good. So it can be risk frequency or loss frequency, right? So risk frequency talks about the probable number of times. Frequency is how something occurs, right? The number of times something occurs. So loss frequency is the probable number of times right, the loss occurs. Then loss or risk severity talks about the probable size, the magnitude of the loss after it occurs. So how many times does the loss occur? Then if it is the severity, what is the impact? What is the size of the loss after it occurs? Pay attention. Now, to analyze the frequency, we are going to use two tools here. It's not difficult, but just pay attention. We are going to use the high. We are going to analyze whether the frequency is high or low. That is how, these are the tools you can use to analyze the frequency. We are going to analyze whether the severity is also what? High or low. So I'll be asking question. All right. So you're going to the A, analyze the loss exposure, which is good. How do you analyze the loss exposure? You tell me. You analyze the frequency and severity of the loss exposure. Okay. Then I also ask another question. How do you analyze the frequency? You say you identify or you analyze whether it is high or whether the frequency is high or low, and the severity whether it is what? High or low. Class, are we good?
Yeah.
So all these I'm teaching is in number 21, the risk management. So someone might think about maybe it's just reading. It's a whole complex one. That's why I opted to solve it last with you guys. All right, go on. But it's not difficult. So just pay attention. Now, if you don't get the concept, you mess up. I mean, I've told you if you get receipt and you come and call me. Just prepare a huge budget. All right, let's move on. So what's the next step? IASM. We've done the I, we've done the A, we are on the S. The S is you select the appropriate risk management technique. So select, right, the appropriate right, appropriate risk management technique. All right, so let's make it this way: technique or method. Method. So you select the appropriate risk management technique. Now, what are the risk management techniques? Pay attention. If the business cannot entirely prevent, listen, if the business cannot entirely prevent the risk, the loss, or the risk from occurring, you rather go and do, or rather apply risk control measures. Risk control measures. These are your lecturers may not teach you. We have to take it's in the slide, but the approach, okay, it's in the slide, but not that they can't teach, but they may not have the time to explain it so much. Risk control measures, right? If the business cannot prevent the loss from occurring entirely, you know there are some losses you can easily prevent them. Let's say, as an individual, you can prevent yourself from getting pregnant if you're a lady. You can easily prevent pregnancy, but there are certain cases where, assuming you never knew you were pregnant and then it got to around 6 months, and that stage the fetus in your womb has grown, has developed. So if you want to abort, you can even die. So what will your parent tell you? Okay, if the pregnancy hit itself and now it's about 5 months, you cannot abort. So just give birth to the baby. That's the kind of example I'm trying to give. All right. There are some cases you can prevent, let's say, getting pregnant. But there are some other cases you cannot prevent getting pregnant because at that stage, all that you have to do is to manage the risk. That's why we are dealing with risk management. So here we are not preventing the risk, but we are rather managing the risk. So if you cannot prevent the risk entirely, what you can do is you go what is called risk control. Now the risk control measures, all right, we go with one. We go with what is called retention. We go first what is called prevention. But this prevention doesn't mean you are preventing the risk. It's a different definition. So when you get that, I'll explain it. We go with prevention. We go with retention. We go with avoidance. We go with reduction. We go with reduction. We go with reduction. These are risk control measures or the techniques or the methods. They are the techniques, they are the measures, they are the the methods. I get in risk control. So if you cannot prevent the loss entirely from occurring, what you can do is you can go for prevention. But this loss prevention is not the same as the prevention I'm speaking about. But because when I define it, you understand it. So all these ones I can add loss to them. Loss prevention, loss retention, retention. The second one is retention. Let me write it properly so you guys can see it. It's retention. That's why I told you the point 4 and 6, they are all in it. So I think I have to write bigger. It's better when I write bigger. Retention. The next one is avoidance. The next one is reduction. I agree. So these are loss control. So I can use loss against all of them. Loss prevention, loss retention, loss avoidance, loss reduction. Or I can use risk prevention, risk retention, risk avoidance, risk reduction. Okay, let's move on. Now, we have what is called risk transfer. It's also another method we can use. So let's go at what is called risk transfer or loss transfer. Risk transfer or loss transfer. So when I'm done, I'll upload a video. You can go through the video again. You can try to solve the. If the video you are already familiar with the content, right? So if you want any interpretation further, you just go back to the video and maybe skip the let it buffer and skip to the portion where you need further comprehension. Then you look at it. If you need further explanation, then you'd adopt it. So risk transfer. Risk transfer simply means you are transferring the risk. Remember what we did yesterday? So at the early stage, the risk transfer to, all right, or let me say it's insurance, right? We can transfer the risk through what? Insurance. Through insurance. Through insurance. So what is insurance? It's the transfer of losses from the insured to the insurer. Then you can continue pulling of resources to indemnify the whole of that. So insurance. Risk transfer is what? Insurance. You transfer the risk. Now, this is called risk this insurance also. So among all this risk control, we have risk financing, right? Now, risk financing. Let me also write that. Risk financing. And risk financing, another way you can call risk financing is called loss financing, which is 26. So risk financing, we go with insurance. We also go with what is called retention. Retention. So risk transfer, You can transfer the risk by means of insurance. Risk financing. You can finance the risk by retention. And among the 30 areas of lecture I give, you also have what is called partial retention. Partial retention. So it's retention and partial retention. Then we have insurance, because these two, what is risk financing? It is the process of providing funds to cater for the losses in the event they occur. Sometimes you maintain emergency funds, right? Some organizations, they maintain emergency funds. Some organizations too, they have some special funds dedicated for risk financing. So what is risk financing? Is the process of what? Making funds available, providing for funds, right, to cater for losses in the event they occur. They can do it by two ways. You can go through retention. Retention is like keeping emergency funds to cater for the losses in the event they occur, or insurance. Insurance is another way of risk financing your losses. That is, you rather pay the money to an insurance company who is which is in a better financial capacity to cover or cater for your losses or indemnify you in the event the loss occurs. So insurance. And we have what is called non-insurance transfer. Non-insurance transfer. Non-insurance transfer means you are actually transferring the losses, but here not by means of insurance. Non-insurance, I'm using just transfer. Meaning you are transferring the loss, but here not to insurance. We have what is called hedging. Hedging is used more in derivatives. That's accounting. Financial management or corporate finance. You hedge against risk, right? We have what is called lagging and leading. If you realize that, let's say I want to buy a dollar, and the dollar in the future, the dollar current price is about 12. In the future, it's going to be 14, right? In the future, it's going to be 14. The risk I can hedge is that I will not buy the dollar today. I'll buy it in the future, like 2 months' time. Meaning I've evaded the risk of buying the. I've evaded. It means that I've evaded the risk of buying the dollar at a lower rate today, in order for me to earn a return on it in the future. Yeah, it's a hedge. Another way of hedging is to lag, right? If so, the first one is a lagging, right? I know that the dollar will be higher in the future, about 14, and now it's 12. So what I have to do is I'll lag, I'll delay, I'll play delay tactics in buying the dollar rate, then buy it in future. That's lagging. And that's why it's called the leading. If I know that the dollar is going to increase in the future, like let's say then now it's 12, then I say in the future it's going to, let's say, decline to around 10, means that I will lose money. So to avoid the risk of losing the dollar rate in future, the decline in the dollar rate in future, the strategy I have to adopt is to hedge it now, right? To hedge it now is saying that I have to buy the dollar now at 12 cedis, now it's around 12 cedis. Then in the future, when it declines to 10 cedis, I'll be safe. So this one doesn't mean I'm transferring the risk to somebody, but it's a strategy I'm adopting. So hedging. Another non-insurance transfer technique is called leasing or rent. For example, if your building is not, you're a landlord or a landlady, and the building, you see that there are some faults in that you cannot fix it. What do? You put it up for rent, right? The loss of the building, or the loss exposures in the building, like let's say sports, what's the name? Sport cables, sport sockets, sport. Let's say the roof is torn somehow, it's broken, the wall is broken, the washroom is spoiled, the sink or whatever is destroyed in the room. They are all loss exposures you have. They are all losses you have there. So the best way you can transfer it, you transfer it by renting it. When you rent it out to somebody, or you lease it out to somebody who come and the person comes to pay the rent, you use that money to fix it. So meaning you didn't use your actual money. You rather use someone's money. So you have transferred the loss. Also, if the building is already in a very good condition and someone comes to rent the building and the person messes up or destroys anything in the building, right? You include it as part of your rent agreement or lease agreement that the person should what? Fix it. I hope you get the concept. Do you get the concept?
Yes, sir.
So that is another type of non-insurance, meaning you transfer the risk, but not through insurance. It doesn't include insurance here. So here you hedge. You go with what? Leasing. These are some types of non-insurance transfers. Are we okay?
Yes.
All right. Let me see the comment section. Okay, someone says retention. Is it part of insurance risk transfer? No. Retention is not part of the risk transfer. Retention is not. I said it's the risk transfer is only one, insurance. And the risk financing is insurance and retention. So insurance is a risk transfer, right? Whereas insurance is also a risk financing method, and retention, because insurance and retention, they all talk about money. They are all in connection with what? Money. I get it. So retention is a risk financing. That retention is when the individual, the insured, could say, I can cover for the losses myself. That is the insurance, the retention, the loss is not so significant, or it doesn't have any bigger severity, higher severity. So he will be like, I can cover for the loss myself. Let me give an example. Let's say Aliyah is driving. Aliyah is a driver. She drives, and Titus has gone to the bar and he's drunk. Right? He went to the nightclub yesterday. So in the night he's driving, and Aliyah was also driving from work. So this Titus, this Aliyah, they all have vehicles. Then Titus's car, because he's drunk, he's intoxicated, he scratched Aliyah's vehicle, who was also, they were in the same traffic, but Titus wanted to maneuver his way out, and then he ended up scratching Aliyah's vehicle. Then they came out. Then Aliyah realized that Titus was intoxicated. He was asking me questions and he was beating about the bush. And by when Aliyah looked at the scratch on the vehicle, he realized it was not so significant that she can even like get a mechanic to fix it for her. I getting it. So Aliyah will tell Titus, "Oh, it's okay, it's all right, but don't drink and drive. Don't." And Aliyah advised Titus, "Don't drink and drive," and then both of them parted ways. So what Aliyah did in insurance, ordinarily, if your vehicle have engaged in an accident, don't you report to your insurance company to fix it for you? Yes. But here, when Aliyah looked at the damage on the vehicle, the scratch on the vehicle, she'll be like, okay, it's fine. Don't worry, I'll fix it. I'll fix it. So you can go. But if it were a major damage, Aliyah wouldn't have allowed Titus to go. If it were a major damage to her vehicle, Aliyah wouldn't have allowed Titus to go. Whether she was drunk or not, she will call Titus to fix it, because the cost involved will be so much that Aliyah may not have the funds to provide for them. So what Aliyah did by telling Titus, it's all right, but don't drink and drive, I'll fix it myself. It is called retention. That retention is that you have funds to be able to cater for the loss in the event they occur. But the risk transfer, which insurance is also a risk financing, is when the loss incurred or the loss sustained or suffered is so huge, the damage is so huge that you don't have the sufficient funds to cater for it. That is when you refer to the insurance company to come and fix it for you. So both are monetary. But one, you can contain it. Retain is the root word. Retain is you can keep something, you can maintain something. So you can keep it because you have funds to cater for it. And another is the damage is so huge, it's so great, the magnitude is so great, the severity is so great that you cannot fix it, but you rather refer it to an insurance company to fix it for you. That is the insurance. So insurance is you are transferring your loss to another entity which has the financial capacity to cater for the loss in the event they occurred, and to indemnify you. At the same time, it is also a risk financing because it involves money. Retention is also risk financing because it involves money. Class, are we good?
Yes, sir.
Vanessa, are you good? Vanessa,
Sir Manuel.
are you okay now?
Yeah.
All right, let's proceed. So I'm on the non-insurance strand, which is the hedging and the leasing, right? We are done with it. So when you talk about selecting the appropriate technique, method, or measure to deal with the loss exposure, these are the areas you are going to look at. Now, don't forget, they can ask the question anywhere, from any angle, from here, the whole process. So I'm going to teach you the strategies, right? Now, let me explain what loss prevention means, the risk control, loss prevention. Loss prevention is, right? You are reducing the frequency of the loss exposure. So it's not like you are preventing the loss entirely. No, it's not the same thing. Here, the loss prevention means you are reducing the frequency of the loss exposure, meaning that loss exposure happens so many times, but because you cannot avoid it, what do? You try to minimize it. You have to minimize the frequency. So if it happens like 5 times or it's so high, you just have to reduce it. Now, loss retention, I've explained it. All right. Then loss avoidance is when you can avoid, you can let go the loss. You cannot prevent, you cannot stop it from happening, but you can just let it be. You can just let him go. Or you can let the loss go. Let me give you an example. You have a boyfriend whose temper is so high. She's so abusive. His temper is so high. His temperament is so high. And also, it is any little thing you say, then this guy becomes annoyed and pissed off. And he may be abusive, or he can be abusive. What you have to do is to let the guy go. He's not the only guy in the world. Say, I know I'm there. I'm there. You can use me for a backup. As you search for someone, if you search for someone and have someone who is a full-time boyfriend, then you leave me alone because I'm a part-time. I good. So we will discuss more. Then reduction is to reduce the severity of the loss. So when the severity of the loss is so high, I've showed you how you can analyze the severity of the loss. The loss is so high, what you tend to do is you reduce it. You try to reduce it, put in measures to reduce it. You cannot avoid it. You cannot prevent it entirely from occurring, but rather you can control or manage it, risk management. So you try to reduce it. That is reduction. And I'll explain retention, I'll explain hedging, I'll explain leasing. When they were leasing, think about rent. Rent is for 2 years, two or more is for leasing. So some books, instead of using rent, they can say leasing. Think about it like rent. Okay. All right. Are we good to go? Any concerns, any questions, any contributions? All right. I believe you are writing. Class, are you writing?
Yes, please.
Yes, please.
Be writing because when I start with the questions, what's the time? 9 a.m. ish. Let me be quick. Now, the next step. IASM. So we are on the I, right? The I says implement and monitor. So what do you implement? You implement the risk management technique. And what? You monitor the risk. You monitor the technique you have implemented, whether it's able to achieve the stated objective. So this is the loss exposure you identified. You analyzed it. This is a technique you have adopted. You implement it. Then you monitor whether indeed the technique or method or measure you adopted is addressing the loss exposure issue, which you have identified. Are we good? Are we good?
Yes, please.
So we are done with the ISM. So implementation, it talks about some process. How do you implement it? Then the monitoring. How do you monitor whether it has been to meet set objectives? Okay. So that is the IASM. IASM. All right. So let me take us through last time, or you should go through. I'll finish with the risk management process. I'll finish with it. The next is I'm going to bring the past questions. We start to solve them. So just go through it and tell me if you have any questions. This is a risk management process. Start from the top here. Any questions?
No question, please.
Tamara.
Yeah. What's the question?
Please, repeating it at both sides.
Come again.
The loss retention, you've written it at the risk control and risk transfer financing.
Yes, I explained why I wrote it there.
So please, can you explain it to me?
I explained that when you talk about the risk, they are all risk control measures because you cannot avoid the loss entirely. I get it. You cannot prevent the loss. If you can prevent it, fine. But because you cannot prevent the loss from occurring, for example, in your room, right? Can you prevent something like naked wires um, from being in your room? Like there's a. Do you think all the time everything in your room, your gadgets, they'll all be perfect? They'll be in perfect condition all the time. I'm asking a question. The gadgets in your room, do you suppose they'll be perfect forever? I'm asking a question. Whether it's your fan, it's your iron, it's your television, your whatever, the socket you have, the wiring, do you suppose they'll be in perfect conditions forever? No.
No.
Sometimes sometimes there will be fault somewhere. Your iron could be faulty. Your some cables in your room or some cables in your room might spark, right? Might be sparking some, certain things could go on in your room, right? Which could expose you to a loss. Like there could be naked wire sometimes, right? That naked wire can expose you to a loss. Sometimes there's something which you can just touch an electrical cable or gadget or whatever, and you have a shock. It's a loss exposure. So because you cannot prevent the loss exposures or the loss from occurring entirely, or the loss exposure from occurring entirely, sorry, you go in for risk control. And I'm saying the retention is a risk control technique. At the same time, it is risk financing. Insurance is also risk control. At the same time, that is what? Risk financing. Are we okay? Bethel, are you okay?
Yes, please.
All right. So now we are done. I'm not going to claim this, but I'm going to open another page. Then on that other page, we will discuss something. So back to what, let's see what we've covered so far. So you've seen that we've covered don't study for exams. Understand. That's why I'm taking my time. If you understand it, it will be with you forever because you know it's practical. We've covered retention. What is partial retention, therefore? Partial retention simply means that the business or the individual can cover part of the loss, and let's say the insurance company can cover the other part, or the business or the individual can cover part of the loss, and the other party can also cover part of the loss. That's partial retention, halfway retention. I cover, okay, you scratch my vehicle. So now what do we do? Then I Titus told Aliyah, okay, this is my number, this is my call card. Find out about the cost. I'll take half, you also pay half. Or I'll take part of the cost. You also take part of the cost. It doesn't necessarily mean you take half. Because probably Titus caused the loss, Titus will be like, okay, I'm going to pay 70%. Whatever the cost, I'll pay 70%. Then I'll take 30%. This one is not any major defect or damage to my truck. It's a minor one. So then that is partial retention. You take a portion. Taking a portion means you have funds to cater for the portion of the damage which has occurred. So we have done with partial retention. Let's see what we have next. So we have also done with risk management. We are still on risk management. We are done with it. We are going to solve the past question. We are done with liability loss exposures, property loss exposures. We are done with loss control. That's what I just did, which is the risk control. And we are done with what? Loss financing, which is the same as the risk financing on insurance and retention. So I'm going to take this document out of the screen. Then we'll start with the past questions. Are we good? All right. All right. So now let's come here. Is it better? Can you all see legibly? Okay, first, watch this. Okay. So this very paper, hold on. This very paper, can you all see it? Hello, can you see it? Is it better? Oh, respond so that I continue.
Yes, please.
All right, that's fine. Let's proceed. Now, risk and insurance money. It's going to take you 2 hours, 30 minutes. It's a paper. You answer question 1, which is compulsory, and any other 2 questions. It's 2 hours, 30 minutes. I'm taking my time because this course, students feel a lot. This is which year? December last year. Regular student, they wrote first and the weekend wrote later. Regular session, risk management, risk and insurance management. So I'm taking this screen out. I'm done with this guy. Let's just go off. Now I'm on this gentleman. Let's see what the compulsory part was. Whenever the question is given to you, listen, whenever the question is given to you, they pick this question from the manual. Whenever the question is given to you, go and read the requirements first. I know my private teaching students here will be like, Semano, why are you teaching everything like this and this and this and this? All right, but I don't have to help you guys. They are priced a lot of questions for me to mark for them over the period during the semester. So here they are having more of revision. But regardless of that, those who just joined, you can still do better by practice. If you practice and they don't practice, you do better than they do or they will do. But if you practice as they have practiced, you also be better. Now, when you're giving the question, don't go and read the case study. Don't go and read the case, Jeff, whatever. Don't read it first. The first 10 you do is you go and read the requirements. You go and read the requirements. Here, you're going to read this. These are requirements. These are requirement. These are requirement. So in total, if you read, and we have a D as well. So it's really packed. We have a D. So when you add all the requirements together, it's going to give you 20 full marks. 20 full marks. 20 marks. 20 marks. 20. Okay. So let's start. Let's read the requirement and see what we have. Do any of the following parties have an insurable interest? It's not an easy course. So do they only have an insurable interest in the building at the time of loss? We've done insurable interest. You have to know what insurable interest is. Insurable interest is a principle of insurance where the insured stands to lose financially, right, from the loss. Stands to lose financially from the loss in the event it occurs. So if you know what insurable interest is from what we discussed, okay, you just go, when you go into the passage, you know what you are searching for. You're not just reading grammar. You're not reading a newspaper. You are reading for specific information. He said, do any of the following parties have an insurable interest in the building at the time of the loss? Explain your answer. So, Jeff, Richard, Gateway Bank. Does any of these guys stand a chance? Or does any of these guys have an insurable interest? So if it is Jeff, you write yes, you write why. If it is Richard, you write no, you write Y. If it is Gateway Bank, you write yes, you write Y. What is that? So the main thing they are here, level 400, they call this our application. You know it. Now, how do you apply it into real life scenario? That's what makes people feel. Next semester, you get international human resource management and other ones. They are all practical. They put the question before you. You have to use the principles to solve the question. It's like a doctor, and you are like a consultant, or you're a doctor, a medical consultant, and someone comes to you with his sickness. So you have to diagnose the sickness, confirm whether what he's saying is true, and that's the first stage. The second stage, you have to recommend the appropriate remedy or panacea, right, to address or deal with or treat that illness or sickness the person has reported to you. So here, does any of the parties have an insurable interest? You should know what insurable interest is. You have to write it down. When the insured stands the chance of losing financially, or when the insured is in a position to lose financially from the loss in the event it occurs. So first, you have to identify what the loss is in the passage. Secondly, you have to identify who are the parties in the contract, right? Who are the parties? Here there are three. So you have to identify, are all these three parties involved in the insurance process? Who stands to lose financially? It can be two, it can be one, it can be all three, it can be one or two or all three. So I'll leave the answer to you. Number B, Richard told Jeff he could save money. Richard told Jeff he could save by taking over Richard's insurance instead of purchasing a new policy. Richard told Jeff he could save money by taking over Richard's insurance instead of purchasing a new policy. Can Richard validly assign his existing property insurance policy to Jeff without notifying the insurer? Explain on your side. Good. So here it's about, let's say you are transferring your insurance policy, right? Mostly like a beneficiary thing. Okay. You are trying to change an insurance. Good. With a policy holder. So here, who is the policy holder? Richard is a policy holder. He wants to transfer it to Jeff without notifying the insurer. Can it be possible? I am an insurance policy holder with Enterprise Insurance. I have a particular policy, let's say mortgage insurance policy, and I want to transfer it to Ima without informing the insurer, which is the insurance company. Is it possible? Explain. So when you are explaining this, you have to write with the terminologies and cite the principles. And cite the what? Principles. So here, if you want to assign it to Jeff without informing the insurer, what kind of principle is he breaching? Are you getting it? So you have to cite the principle. Let's move on. Do you think Jeff's insurer should pay or not pay for the damages? Explain your answer. So you have to first analyze the situation. Jeff is the insured. Jeff's insurer. Should he pay or not pay for the damages? Explain. So when you understand the principles, no matter the case study, you can be able to deal with the case study if you understand the principles. All right. D. Investigation of the fire revealed that an electrician improperly wired an electrical outlet in the restaurant. So how were they able to identify the loss exposure? It was through inspection. So they did an investigation. Remember, we've done the risk management process. The first is to identify the loss exposure by there are types of loss exposures. There's a property loss exposure because it's affecting the building, the restaurant, the building. So it's a property loss exposure. What was the source? How were they able to identify the loss exposure? Through investigation or inspection. So investigation of the fire revealed that fire was a loss exposure, revealed that an electrician improperly wired an electrical outlet. That's why we are saying that you can never have a perfect situation where everything in terms of losses, probable losses to occur are perfect. There will definitely be issues. You cannot prevent it entirely, but you can control it. You can manage it, right? So the electrician improperly wired the building. That's a loss exposure. You are exposing the building to fire. In the restaurant, which caused the fire. So the loss exposure was the improper wiring. And the fire, we can say, is the loss exposure element, or the fire, we can say that it is the peril. Explain how subrogation might apply in this case. 6 marks. Investigation of the file revealed that. So when it says subrogation, what must come to your mind? There's a negligent third party. There's a first party. There's a second party. There's a negligent third party. So subrogation is the legal principle in which the insurer or the insured, the insurer makes claim on the negligent third party for payment of losses caused, right, by the negligent third party against the insured. That's subrogation. So another thing about subrogation, which I didn't explain in our first meeting, was that for the purpose of subrogation, remember, you are not to benefit twice from subrogation. So, for example, if in an insurance, let's say in the event of a loss situation, let's say a damaged vehicle, and like I was using Titus and Aliyah, for example, Titus' vehicle now damaged Aliyah's vehicle properly for Aliyah to feel the pains, right? And the cost involved is so much that Aliyah reports to her insurance company, which is the insurers, to come in and save the situation or salvage the situation by indemnifying Aliyah. Aliyah's insurance company or the insurers, they will fall on Titus and his insurance company to make the payment of the losses. But then the damaged vehicle would be seized or will be taken over by the insurance company. Why? You are not to benefit twice. If they buy you the new vehicle, which is not entirely new, but of the same model or around the same brand, of the same year use, right? If they purchase you that, which is, we will say, the new vehicle, they will take away or they will retrieve from you the damaged truck. If they leave you to possess or they leave the damaged vehicle in your possession, after having bought you a new vehicle, you benefited twice. Meaning you have a new vehicle, you have the old vehicle. So the old damaged vehicle, you can sell it for scrap and get money out of it. That is a gain. And insurance, you are not to gain because you are dealing with pure risk. Private insurers insure against pure risk. A pure risk is a loss situation, or it's a situation in which there is no loss or no chance, or there is no loss or there is a loss. Are you getting it? So that's it. So subrogation is, you have to study the case and tell why subrogation might apply here. So here you have to write your grammar. And don't write anything. Just write based on the principle of what? Subrogation. So if I'm to solve this question, I'm going to use subrogation as a principle to deal with it. I have not even read the case study, but I already know what I'm going to answer. I already know how I'm going to answer. That's one of the benefits of reading requirements first. If you read the requirements, you can imagine, because the whole thing is, it will not depart from the principles you know to solve the issue, right? So the whole investigation, whatever, what they need is a subrogation. So when you write on a subrogation, you apply it to solve the problem. You don't just write subrogation, define it, and go away. No, define it and stay there and solve the issue, solve the problem. So here you are working like a consultant. Somebody has approached you. People ask you questions. You must be able to tell knowledge, display knowledge that you understand the concept. Not, oh, me, I'm studying, I came to university to come and study to write exams and pass and go. No. Otherwise, you make foolish decisions in life. Very good. So here, you understand the concept and you're applying it. You're applying it. All right, let's continue. So that's how you approach this question. Let's move on to the next one. Let's see what we have. Answer any two questions. Okay, so what has led me here is the risk management process. Every year, the question comes from that area. So question 2, I'm not going to read the case study. Those grammar, they will confuse me. I'll just go to the requirement. Question 2 also has how many marks? Where's the other one? Okay, let it be here. So question 2 has how many marks? Let me go to question 2. It must also have 20 marks. So I'm just taking it from the requirement before I go and read the case study. Assuming you are the risk officer for Vanguard Assurance, do a risk analysis for this case by identifying 2 loss exposures. 2 loss exposures in this story and evaluate them. B, what techniques, they can say methods, they can say measures, they can say approaches, would you use for each loss exposure? Explain your answer. 4 marks. So we are back to the risk management staff. C. Can the bishop make insurance claims on Vanguard Assurance? Explain your answer. 4 marks. State any 4 conditions for which Vanguard Assurance will be required to pay for the other damaged car. Explain your answer. Will the people in the other car be indemnified by Vanguard Assurance, assuming their car did not have insurance? Explain your answer. It's basic. The principles. They are not difficult. You understand the principles, you can be able to go. Now, I'm going to solve question 2. I'm going to solve question 2. Let me minimize the screen a bit. All right, so I'm going to solve question 2. Okay. All right. So now, let's proceed. So I've read what the question needs. Let's see the approach. Someone should start reading for us. Quick. Please be quick. Someone should read. Read for us quickly. Pamela, read. Pamela, read. Okay, let me read. I don't want to spend so much time on this. In October 2024, an incident occurred in which a 16-year-old son of one bishop was driving his father's Jaguar car in East Legon at top speed, which resulted in an accident. The boy did not have a driving license. The car crashed into another car, and both cars caught fire, resulting in the death of 2 persons. Assuming the bishop's insurance company is Vanguard Assurance, A. You are the risk officer for Vanguard Assurance. Do a risk analysis for this case by identifying 2 loss exposures in this story and evaluating them. The first thing which must come to your mind, this question, the first thing which must come to your mind, he said you should identify 2 loss exposures. You should identify 2 loss exposures. Yes. So what are the 2 loss exposures here? He says you should identify the 2 loss exposures and evaluate them. So the first concept, what comes to mind? That's the secret. If you're able to know what comes to mind, you'll be able to do this work. What comes to mind?
Hello, sir.
Yes, who is this? Titus.
Titus. Yes,
all right,
please.
what comes to
Please, the question. I can't see the question.
You can't see it. So you leave and rejoin. Who else can see the question?
Okay. Me.
Who else can see the question?
Sir Godwin.
Leave and rejoin. You see the question. Can you all see the question displayed? All right, everyone. Those who can't see, just leave and rejoin. You see the question. So that's the question we are solving. Please, it's tomorrow. So we don't have to waste time. But I'll give you 30 minutes more. By 10:30, I'll be done. I'll solve 2 or 3 of the risk management questions. You see how the approaches. Then that'll be all. So I can share the session on the page. You guys would go and watch it, and whatever you want to do, you start have now till tomorrow. So yes, what comes to mind when you read the A? Assuming you are the risk officer, do a risk analysis for this by identifying 2 loss exposures in this story and evaluating them. What must come to your mind? Yes.
Property and liability.
Mate, that's fine. Very well. Well done. Who else? Hello, who else? The question is twofold here. Maybe some of you have not paid attention to it. You do the 2 loss exposures and you evaluate them. They are twofold, so give me 4 marks. So probably the 2 loss exposures will give you 2 marks. Evaluating them will give you 2 marks. So what comes to mind? What concept comes to mind? What is a strategy? Exams is approach with strategies. Take it from me. If you think you are just going to read and write, you cannot do some exams. Exams are written with strategies. So what's the area the question is emerging from? Which you must know the area or the angle the question is emerging from. The area this question is emerging from in your slides is called the risk management process. That's the area. Because if you don't know the area, when they say subrogation, you know where the question is emerging from. It's emerging from what? Legal principles of insurance. So because you know that it's coming from legal principles of insurance, in your definition of subrogation, you know what goes into it. So yeah, this question is emerging from risk, right, management process. So when you say risk management process, what comes to mind? IASM. This is where the question is coming from. I've told you every year a question comes from risk management process. Every year. I'll pay the weekend students question. You see there's a question from risk management process. This is last year, last 2 years, last 3 years, last 4 years, last 5 years. You always get questions coming from here. Very good. So the first thing you have to know where it's emerging from, otherwise you make mistakes. It's coming from risk management process, IASM. And they said you should identify 2 loss exposures. Where in the IASM is this question emerging from? It's emerging from the first stage, the first step of the process. There are 4 steps: identify, analyze, select, implement, and monitor. So this is step 4, this is step 3, this is step 2, this is step 1. So identify 2 loss exposures. They are coming from the I, the first, the types of loss exposures. In this, and evaluate them. Evaluate them is coming from the A. You analyze. Evaluating is assessing, analyzing, scrutinizing, examining. So it's coming from the A, 2 marks. Then you go to the techniques. The techniques is the 3rd step. I get it. What techniques would you use for each loss exposure? The 3rd step. You must approach the exam with strategies if you want to be successful there. So to make life easier, master the strategies which I'm teaching you. You'll be okay. You can easily score your A or B plus and you'll be gone. All right, it's very easy. So that's it. What techniques would you use for each loss exposure? Explain your answer. Risk. The first thing is risk management process. Then you write your risk management process somewhere. You write it somewhere. The acronym. You need an acronym. Write it somewhere. Now let's go and analyze it. Let's go and analyze it. Let's see what we have. Okay. So from the question, right? From the question, what are the 2 loss exposures? Identify 2 loss exposures, meaning there could be more. So what are the 2 loss exposures in the question? Class, be quick, be quick. What are the 2 loss exposures?
So it's property and liability.
Yeah, so tell us, why property, why liability? Okay, somebody can, if you want to tell us, fine. Or someone can also tell us, why property, why liability?
Okay, for property, because the vehicles caught on fire and there was an accident. And then liability because 2 lives were lost. So there could be legal implications for that.
Okay, that's good. So now, let me tell you what we are doing here. We have done it all. We did it today. Liability, loss exposure. My screen is always slippery, though I can it multiple times. Liability. So property, she mentioned specific things there. She mentioned the vehicle, the accident, the vehicle getting bent. So the vehicle, the accident, or the burning of the vehicles. It's a property. Vehicle is someone's property, so it's destroyed. Liability, lives have been lost. They can be sued. There could be legal implications, legal consequences. Are you getting it? Are we getting it? If you can't see the question, you leave the page, you rejoin, you see it, because others are seeing it.
Semano,
So
please
you
go
just
over.
come again.
Kindly go over.
Who is that?
Nanelia.
But what name are you using on this page? Because I can't see your name here.
Oh, I came to visit Elom, so I'm here with her.
I believe you are not doing what I'm thinking. Two ladies meeting together.
No, we are not doing what you're thinking.
Very well. Hallelujah for that. Okay. We are saying that you go with, you identify property loss exposure, but there's a specific property loss exposure in the question. The accident of the vehicles. Right? People are entering who haven't paid. These people. Okay. Let me just allow these people. Okay, so property loss exposure. Which particular loss exposures under property? Right? He said the car crashed into another car. So the car crashing into another car is a loss exposure. The two cars crashing is a property because they are the properties of individuals which have got spoiled, which have been subjected to losses. Both cars caught fire, resulting in the death of two persons. So there has been death. So there could be a liability loss exposure. There could be legal implications. There could be a suit filed against the guy's parents. And it's a real issue. This is a realistic case. The name of the bishop is Bishop Salifu Amwako, right? And his son drove that vehicle without license. I think it was 16 or 18-year-old, 16-year-old, yeah. And he ran into this and this happened. So you have to be able to identify the two loss exposures. If you're able to identify them, right, property loss exposure is in the 30 questions, 30 areas your lecturer gave, and liability loss exposure. Then you specify the type of property loss exposure. You specify the type of liability loss exposure. You are good to go. We can even talk about personal loss exposure. That is death of people. Death of people, the death of two persons. It's a personal loss exposure. There's also liability loss exposure because they can be sued. And truly they were sued. So you have to identify specific loss exposure. So you have the accidents or the two cars crashing, which are property loss exposure. We have the death of people, personal loss exposure. We have the probable suit to affect them. That's legal implications. That is also what? A loss exposure. We are done with question A, the first part of it. The second part is you have to evaluate these loss exposure. Now we come to, when we say evaluation, we have to think about analyzing the loss exposure. So how do we analyze loss exposure? Let's find out. Everyone should contribute. How do you analyze loss exposure? Raise up your hand, let me call you. How do you analyze loss exposure? Let's be quick. I have to do my studies or something around 10. I have a long, about 8-hour video to watch. So let's be quick. How do you analyze loss exposure? Maybe some of you have forgotten. Let me guide you. All right. Watch here. Watch. Maybe some of you have forgotten. Who is in the waiting room? You've forgotten. So watch here. How do you analyze loss exposure? Watch. And see whether you can tell me something. Yes. If you want to say, let me see your hand up. Quick. Whose sound is that? Irajua, Vanessa. How do you analyze loss exposure?
Same, I know, measuring the frequency and the severity.
That is very good. That's what I want. He says you evaluate the loss exposures. So how do you evaluate them? You have to use the frequency and what? Severity. You have to use the frequency and severity. Good. Now, how do you measure the frequency and severity? Another person. Let me see your hand up. How do you measure the frequency? Let me see your hand up. It's on the screen. It's on the screen. Some of you you have seen the screen, but if you literally close your eyes, you shut your eyes. You've used a dark cloth to bind your eyes so I cannot see. Open, remove or untie your sight, and then open your eyes. You see it on the screen. Yes, how do you analyze or measure the loss exposure? Anita, speak. Hey, Dede, how do you analyze the loss exposure? You said we use frequency and severity. So how do you analyze the frequency? How do you analyze the severity?
Say, by using the high and low method.
Did I even call you in the first place? Why are you so in hate? Who spoke? Is it Dede who spoke? I didn't call you. Then Laurentia, you spoke. Okay, let's be quick. You use the high and low. It's over here. Watch. I'm using green. Watch. Here. It's here. It's here. To analyze the loss exposure means to evaluate the loss exposure. So use the high and low. So how do you analyze? You analyze the frequency severity, then you see whether it's high or low for each of them. All right, let's move on. Back to our question. So you've identified the loss exposures, you evaluate them. So how do you evaluate them? You evaluate them based on the frequency and severity. So when you pick each of the loss exposures, let's say the accident, you would evaluate the loss exposure. So when you're evaluating the loss exposure, quickly, let me come down here. So I'm evaluating. Watch. Before I continue, watch this. Of these four processes, stages of the process of the risk management, the first and the second, the second and the third stages, you would use what is called risk management mapping or metrics. So the 2 and 3, they move together. And look at what the question said. B, what techniques would you use for each loss exposure? Explain your answer. So look at the 2 and 3. You use a risk management matrix or mapping or framework. So I'm going to use the evaluation. I'm doing the evaluation. How do I do the evaluation? I'll say using the risk management matrix, using this one. Someone will be like, it's plenty. I'll not choose the question. Look, if you look at the weekend students, their question, the easier questions are question 1 and this risk management and another question. The other question, which is about something benefits, if you didn't read about it, you might be wanting. So you are bringing the question, you'll see it. The easier questions were the 1 and this. It's because probably it is now, but it's not late. It's not too late. You can still practice by getting it. So using what? Risk management matrix. Or risk management mapping. This is how it is. You divide into 4 quadrants. You have to draw it in exam, so divide into 4 quadrants. The left-hand side, we call it frequency. The below one, we call it severity. All right, good. Then we said we use high and low to analyze frequency. High and low for frequency. High for severity, low for frequency. On the number line, the x-axis, right? To the right of the x-axis, the number is increasing, so it's high. Then closer to the origin, that's a 0, is low. So if you have a high frequency, so now so this is how you analyze it. The loss exposure, was it having a high frequency or low frequency? Right? So let me write the loss exposure at the top. You use it to analyze for each of them. I get it. You use this to analyze for each other. So yeah, though I'm drawing this for the A, though I'm writing this one for question A, I'm going to use this same metric to solve it for question B. I hope you get it. I'm going to use this to solve it for question B. So though I'm drawing it for question A, I'm going to use the same to solve it for question B. So when I draw it once, that's all. So I'm evaluating it. So the loss exposure, I'm going to use to evaluate the two losses. But one is the accident. So first loss exposure, accidents. Okay. So for the accident, what will you say about the accident? Now for the frequency, how many times what the frequency of the accident? The frequency of the accident, was it high or low? Meaning, was the accident or did the accident occur multiple times? Was the accident occurring multiple times, or it was just a one-time thing? Who can tell me? The accident which occurred, the car crashing, right? The loss exposure is accident. You can even say loss exposure is over speeding. But here, let's say the loss exposure is accident. The accident, the frequency. How many times did the accident occur in the situation we just read? In the case study we just read, how many times?
Once.
Once. So what is the frequency? Is it high or low?
Low.
Low. So it is here. That's the first part. So the frequency is low. What about the severity? The impact of the accident after it occurred. Was it severe or it was not severe?
Severe.
Severe. So if it was severe, was it high or low?
High.
Good. So the frequency was low, the severity was high. So it falls into this quadrant. Am I correct? This quadrant, so let me write it this way. I'm using black. We have quadrant 1, quadrant 2. We have quadrant 1, quadrant 2, quadrant 3, quadrant 4. So it says that from the given situation, this very particular accident, which is a property loss exposure, it has a low frequency and it has a high severity. Which quadrant does it fall? It's quadrant 4. Am I correct?
Yes.
Good. So now watch. It says you should evaluate them. So I'm solving all this together. I'm solving this. For example, I can even immediately I see the question, I can draw this at the top. Then I'll come down A, B, C. So based on the metrics, I'll be answering the questions down, right? Because some of the questions I'll be picking them from the metrics. So I'll just draw the metrics there, right? And then I'll start answering using the metric to answer A, B, C. So first the metrics, then the A, B, C will come below. They'll come below because I'm going to use the whenever there's anything risk management, learn this metrics. That's what you use to solve the question. And it comes every year. It features every year. So when there's anything risk management, you're able to identify that this is a risk management question, this is a risk management process question, this is not a risk management process question. But it's a risk management process question. That's how you solve it. You first identify the loss exposure. The second one is what? Analyze it. Analyze the loss exposure. Use the frequency, severity. The third is you select. And I said the analyze and the selection, those two, we use the risk mapping to answer those two questions together. So I can draw this diagram and I'll use the other ones to follow it. Now, watch. So in these quadrants, 1, 2, 3, 4 quadrants are the techniques, the methods we talk about, the risk control measures, the risk control techniques. They are the techniques. So we'll go with a basic acronym, to help us. I'm using red. I'm in haste because of I need time to do certain important things. Right? We'll go with the acronym. First, I'll write loss. 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 It's a lot. That's why mostly when the semester begins, we begin with the private tuition. Then we start to teach you all the techniques. You understand. You solve a lot of questions. I'll mark for you. You already. So by the time the exams are closer, you are very skillful. You know how to approach a lot of questions, right? Because for now, just in 2 days, you've seen that we've covered a lot, or 3 days, we've covered so much. So it's always best we begin early. Then we'll solve a lot of questions. You understand the concept better. Not only for examination, you can score an A, and yet you may not understand the concept because it's application. Are you getting it? So for those who we are doing it, you've joined our class. You have to practice. If you practice it, fine. You can have time. You have a whole day and tomorrow to practice it. You understand the concept. So loss. I've written loss throughout. Then I'll go with the acronym PARI. 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 So look at the way I'm going to start it. I'm going to start from 1. The loss P. The P stands for what? The risk control, prevention. Prevention. You can write it in full. Prevention. Okay, mostly if you want to write a shin, this I'll write a shin. Prevention. Then I write the end exponents, prevention. Then I'm done with the A. I'm with the A. A is what? Avoidance. So loss, avoidance, the risk control. You know, this situation, they cannot avoid the accident because the situation, the gentleman overspeed with a loss exposure, overspeeding itself is a loss exposure. The accident is also a loss exposure. You cannot prevent it. It has occurred. It's a loss avoidance. The next R is retention. Retention. So retention. N at the top. N is representing the shin. Then the R is called reduction. So reduction. Then shin. The end exponent is shin. Or reduction or I insurance. In some books, instead of retention, they can say assimilation. They can say assumption. Assumption means you assume it. When you say you assume something, you take care of it. You be in charge of it. So instead of saying loss retention, they can say loss assumption. But let's go with what we are doing here. Because assumption is not in your work, it's rather retention. So you write loss, you write PARI. These are the risk controls. I hope you're okay. Are we good?
Yes, please.
Okay, so now, when we took an accident, what is the question saying? The question should evaluate the loss exposures. So we evaluated the first loss exposure. Now let's evaluate the second loss exposure. I'm using blue. So what is the second loss exposure? Let's evaluate it. What's the name of the second loss exposure? You can choose several of them. Overspeeding is a loss exposure. Accident is a loss exposure. Burn of the vehicle is a loss exposure. So which one should we go for?
Overspeeding.
Overspeeding. Okay, let's say overspeeding. Overspeeding. Let me put it as OV. So overspeeding. Now let's analyze it using the frequency and severity. The frequency. Yes, the overspeeding. What was the frequency? How many times did he overspeed with the vehicle?
Once.
So it means the frequency is low. What about the severity of the overspeeding? After the impact,
High.
the overspeeding was high. So severity was high. So that's one also. Which quadrant does it fall? Which quadrant does it fall? Yellow. So just check the quadrant. Okay, let me write it.
Quadrant.
Watch. Quadrant 1. You have high frequency and low severity. So quadrant 1, it gives you this quadrant 1, you have a low severity here, and you have the high frequency there. That's quadrant 1. Quadrant 2, we have high frequency versus high severity. Quadrant 3, we have low frequency versus low severity. Quadrant 4, we have low frequency, we have high severity. How do you guys get it?
Yes.
Yes,
Good.
please.
All right, so that's what we have now. So that's the question says you should analyze, evaluate the loss experience. So in evaluating, you write on the frequency severity only. Don't bring the techniques because the techniques are selection. They say you should analyze it. You are analyzing the frequency severity and then the high and lowness of highness and lowness of each of them. So when I pick accident and I'm going to evaluate accident, I would say in evaluating using the risk management metrics above, I've written it above, right? The frequency of the loss exposure, the frequency of the accident loss exposure was low. This is because the accident only happened one time for the first time. So it's just one time. It happened for the first time. But the severity, which refers to the impact or the size of the loss after the size of the loss exposure after the loss occurs was high. This is because the accident led to the death of 2 persons, or the accident led to the burning of 2 vehicles. Are you getting it? The accident led to the burning of 2 vehicles, right? Therefore, the frequency of the severity of the losses of the accident loss exposure was high, and it was low, and the severity was high. Case closed for the first one. Second loss exposure, overspeeding. The overspeeding was the frequency was low because it was the overspeeding occurred for the first time per the case study or per the scenario above. But the severity of the overspeeding led into 2 vehicles, the Jaguar vehicle crashing into the Jaguar SUV, crashing into another vehicle. So the severity was high. Are you getting the concept? Are you getting the concept?
Yes, please.
Yeah. So it will feature every year. I've told you every year. Question from here features. Now let's go to them. So this is a B. Sorry. Let's go to the next question. Any question?
Yes, please.
Yeah, what was the question?
So please, for the frequency and severity, we have to link it to the case, like of how many times the accidents occurred, not like a generalization of accidents that can happen.
No. You link it to the case, narrow to the case study.
Okay.
I've told you, like medical consultant or practitioners, and someone comes to you in the hospital and tells you, "Oh, doctor, I feel my head is aching me." You know, sometimes your stomach could be aching you, but you feel the impact in your head. So it will cause you very severe headache. Meanwhile, it's in your stomach. So for you, you are telling the doctor, "Doctor, my head aches me." It's up to the doctor to, the doctor will interview you. He's trying to identify the loss exposures leading to the loss of your head aching you. So we asking, so what did you eat yesterday? What has happened? What is this? What is this? What is this? He's trying to identify the loss exposures leading to the loss which has occurred, right? But then he would actually prescribe the appropriate solution to deal with your headache after he identifies the exact loss exposures. Then you select the appropriate techniques to deal with it. So if you generalize, assuming you have to generalize the accident and not solve the case study, because the case study is a problem which has been presented to you as a risk and management student or consultant, an expert, and your expert opinion is needed to deal with or address the issue. So if you go and generalize it, it's just like somebody telling you, like in the case of the medical consultancy case, where patient come to tell the doctor, "My head is aching me." It's not the doctor trying to deal with the headache. If the person is a beautiful lady, the doctor will tell you, "Oh, you are very beautiful. I like you. Would you have my number? Let's meet tonight. I'll take you out on a date." The person's case is what? A headache. Deal with the headache issues surrounding the headache. Then the doctor has now branched off, has veered off the track or the trail, or has been derailed talking about beauty and dating. All right. In such a case, you'll be marked down. You will say that you are not doing well because you must give solution to the case study. Exactly. Or the person is talking about a headache and you are referring to the headache to another person's headache, different from this person's case. That is generalities, right? So whenever you are giving the case study and you are giving the issues, you use the principles. That's why you have to first identify the area, the angle from which the question is emerging. Which area in the slides is the question emerging? If you're able to know the area, solving the question will be very easy for you. The only thing is you pick the principles from the topic in the slides, which the question is emerging from, and then use it to solve it. It's the same everywhere, right? When I'm writing my CA papers, I read the requirements, I get a because I study very well. I get a okay, this one is coming from this area. I'll deal with it. I will not write as expertly as the examiner wants it, because after the exams is over, after a month or two, you see the solution. You realize, okay, what I wrote and what the examiner wrote, they are not the same grammar, but they establish the same concept to deal with the case. So that's what I'm trying to tell you. You'd have to use the principles to deal with particular case study in question, no generality. So here you are using the principles to deal with the accident caused by the young 16-year-old man. Guys, are we all okay?
Yes, please. Thank you.
All right, that's fine. So let's move on. The B says what? Let's see what the B says. The C says what? The B says, now we've evaluated them. Use the high frequency and severity, high and low, high and low. Now B says, what techniques would you use for each loss exposure? So you see, he's following the ISM. First, identify the loss exposures, the type and the particular. The type is property. The particular is accident. The type is liability. The particular is death of persons. Now, he said you should analyze them. You use the evaluation. Now, the second is what techniques. They are talking about the S, the third stage. Explain your answer. So let's go. So looking at this, you are solving the B. Looking at this, where all the two loss exposures happen to find their way under what's the name? I can also say before that, I can also say that the overspeeding, I can also use this method. It will be correct. It is correct. I can say the overspeeding, the frequency was high because he was overspeeding. I get it. And the severity was also high. I can also use this method. It's also correct. The frequency was high because he was speeding more than the required hours. The speeding was happening at a higher rate. The speeding was happening at a higher rate. Or the overspeeding was just one time, only once in the case study. Or he was speeding. It all depends on the interpretation I'll give, the explanation I'll give. That will let the examiner understand my concept. So I can say the overspeeding was a high frequency because he was speeding at a very high rate above the normal. Or if it's a low frequency, the speeding happens only once in the case study. We never learned that he oversped today and 2 days later he also oversped, but it was just once. So I can use high frequency for the overspeeding and also high severity for the overspeeding. I can also use low frequency matching with high severity. Class, are we okay? Are we good?
Yes.
All right. So now we are talking about the techniques. The techniques are what are written in red in the quadrant. So if the accident, the loss exposure or accident loss exposure, we said it had a low frequency and high severity. What techniques do you recommend? It says for each loss exposure. So you write here accident loss exposure. So B, right? Accident. I'm using LE for loss exposure. Technique. What technique are you going to go for? It has a low frequency, high severity. What technique will you go for?
Insurance.
You can go for insurance. Then the next one is, we have what? The overspeeding loss exposure. Overspeeding loss exposure. Also, what will you go for? What technique will you go for? Uh-huh. Oh, just check. We went for what? Low frequency, high severity. So what technique is there? Don't go and choose anything which falls outside. Come
Insurance.
again. Okay, insurance. Or there are two that you can go for what? Loss reduction.
Yes.
But if you went for, don't forget, based on your evaluation or analysis, right? You should be able to determine the technique. So don't go and choose, let's say, overspin. You said low frequency, high severity, which should be either insurance or loss reduction. Then when it comes to the technique, you go and choose loss retention. It's wrong. Because now the examiner wouldn't know what you are trying to mean. You said this is the evaluation. This evaluation, use these tools to evaluate the loss exposure. Now you come to the technique. This should be the corresponding technique. But rather go and choose a different technique with different evaluations. I hope you get it. If you go for high frequency, high severity, what do you think your technique will be? Check.
That'll be
High frequency.
avoidance.
Avoidance. You go straight to avoidance. So depending on what tools, but depending on the technique, that determines. So you can go with one, loss reduction. So one, loss reduction.
Sir,
Loss. Yes.
a question.
Yes. Continue.
Yeah. So, sir, with the first question, the one that said we should evaluate the loss exposures. Can we just draw the matrix and then just do the frequency and then the severity, so that when we are identifying the techniques, that one too we can include this one.
It's okay. It's
yes.
okay. Yeah.
So that means
Yeah.
you
You
are
can
going
do it
to
that
draw
way.
two matrices or something.
Yeah. One for A, one for B.
Okay.
But the B one will contain the techniques.
Okay.
Yeah, you can do it that way. That's fine. So loss reduction or loss what? Avoidance. And he said you should explain them. Explain them. How many marks for that? Let's see the number of marks.
4.
4 marks. So to explain them, you pick loss reduction and tell why you link it from the evaluation. Because this. Because there was a high frequency, low frequency, and low severity. Insurance is the best to deal with the accident. Why? The accident brought a loss of car, property loss exposure, properties gotten destroyed, and personal loss exposures, lives got destroyed, lives were lost. So insurance will help cover. If you have insurance, the insurance can even pay for the funeral service of the two girls who died. Insurance could also help you recover your vehicle. So insurance is there. So you link it. Due to the evaluation of the accident loss exposures, where there was a frequency of this and this, or there was a low frequency and high severity, right? The appropriate technique is insurance. Then you define insurance. You can write is the transfer of losses from the insured to the insurer, right? To cater for the losses of the insured in the event they occur by indemnifying the losses. Are you getting it? That's it. It's simple as that. That's for the accident. Then it comes in to the overspeeding, loss reduction, right? Due to the low frequency of the loss exposure and the high severity of the loss exposure after the loss occurred. The loss reduction is the appropriate technique to handle the loss exposure. So loss reduction refers to the reduction. Let me say, loss reduction refers to reducing the severity of the loss after it occurred. That, in other words, in subsequent times or in subsequent engagement, the driver should not overspeed. You are reducing it. So overspeeding, the rate at which he was overspeeding, the severity of the crash was caused by the overspeeding. Assuming he was not overspeeding, do you think there could be a death of persons? No. So loss reduction is in subsequent engagement, the driver should reduce right? The driver should reduce overspeeding so as not to lead to this accident. What if it was avoidance? Loss avoidance means that overspeeding. The driver should never overspeed. He should just avoid overspeeding. Here, not reducing. Here, he should avoid overspeeding so that no loss will be engaged in. So when I'm on the highway in a vehicle, like in a commuter, I mean buses, these mini buses, I pray because some of the way the drivers overspeed. And I've always seen accidents. Some of the vehicles are overturned. Some of the vehicles is facing a direction, let's say the right direction, or is facing an opposite direction. When the accident occurs, then he will tend to face the opposite direction. So when I'm on the highways, it's prayers. God should take me. And if you don't believe in God, when you're on a highway and there are overspeeding vehicles, that is when you remember that there's a God. I get it. So God, take me and bring me, because and it's a highway place, it's a highway. Immediately you set off even if you are driving on your own, it's a highway. So you meet this heavy duty trucks, this long vehicle trucks carrying loaded items on their trunks or something on their racks. You meet other private vehicles. It's just highway. I get it. So that is it. Have you understood the concepts?
Yes.
All right. Let's go into the next question. Okay, let me go and copy this one. How do I paste it? Hold on, I want to paste it there. Sorry, continue. Okay, so let me bring the next question. It's easy. Okay, but it's technical. I think the question will be easy. You're on level 300. It's applications throughout. We're going to apply concepts. So okay. Hold on a moment. Okay, so this question 4, and it's about the partial retention program. So I'm using red font color. Here's it, partial retention program. It means that Swift Corporation is going to take a portion of the losses when they occur, to cater for the losses when they occur, and they would also outsource a portion of the losses to an insurance company, transfer the portion of the losses to an insurance company to cater for it, right? So that's a partial retention. Full retention is when the business caters for the loss using its own funds. Full retention, the business caters for the loss, uses its own funds. That's what we dealt with in the risk control technique. Partial retention, the business caters for part of the losses using its own funds. Then we go to explain the 3 advantages of partial retention program to the Swiss Corporation. Right? For example, the business will have to pay minimum premium. You don't have to pay high premiums compared to transferring all the losses to an insurance company. Very good. It means that it says identify any 3 factors that Swiss Corporation should consider before it adopts a partial retention program. So the business must have one, let's say, emergency funds, which it will use to cater for the losses. 2, the business must have implemented loss control measures to minimize the risk don't forget, if there is loss control, it doesn't mean you only have loss controls or risk control measures when you cannot prevent the losses. So, but you can implement policies or attempts to minimize the losses. Identify any 3 factors. So you can talk about the factors. You have to explain them because there are 6 marks. So you don't have to write and go away. You have to explain. If a partial retention program is adopted, what are 2 methods that Swiss Corporation can use to pay for physical damage? You see, retention has to do with what? Paying is money. Risk financing. I've told you. It's risk financing to pay for. What are the 2 methods that Swiss can use to pay for the damages? Now, 1, you can go with what? Keeping emergency funds so that I can use the emergency fund to pay for it. I get it. Secondly, 2, it could be paying on let's say promptly. You can either have emergency fund, you can have other methods you can use. So you just find it on it. That's about the partial retention program. I think last year they were the same areas. They just changed a few of them. Now, identify 2 risk control measures that could be used in the company's partial retention program for physical damage losses. 2 control measures that could be used. Now, let me explain something. Listen. You see, when we were dealing with the other one, because the network broke off, I had to go off and I'm back. Listen. When we were dealing with the measures, we spoke about loss reduction. That is loss reduction. That is when there is a high, there was a low frequency, there was a high severity. So we went for loss reduction. Oh, what do we say loss reduction is? It refers to the reduction of the severity of the loss after it has occurred. So this is the technique, this is the method. What specific action should you take to exhibit or demonstrate or implement loss reduction? So when you go to the implementation, there are the specific measures you are going to take. So we have the ISM, the I implementation. What specific actions would you take under loss reduction? Are you getting it? For example, the child drew the vehicle, it was overspeeding. So if you are saying that the frequency was low and the severity was high and there should be loss reduction, what should we do to deal with the severity so that it doesn't occur for the second time? I guess it doesn't occur for the second time. The technique is that parents should monitor their children, right? Parents should monitor their children, right? Whenever they are driving. That is one. Or the child, the overspeeding, the child should have a driver driving him. He should not drive on his own because he's underage. He even didn't have any license. So those are like specific measures I'm taking under what? Loss reduction. To reduce the loss, the severity of the impact. That the next time when he's driving, there should be an accident. So what specific action should I take under loss reduction to control that attitude of, or to control that loss exposure of overspeeding? The child should be driven by a professional driver subsequently. Class, do you understand it? Class, do you understand it? So loss reduction
Please, can you go over again, sir?
Loss reduction is a technique. What particular action should be taken to control the attitude of loss reduction? What specific action under loss reduction should be taken to deal with the loss exposure? The child was overspeeding. He was riding alone. He was overspeeding. He rushed into another vehicle. And we are saying that the frequency of the loss of that overspeeding loss exposure was low, but the severity of that overspeeding loss exposure was high. So we said that we concluded on that the technique is loss reduction. If the technique is a loss reduction, what specific action should you take to deal with that loss exposure? That is what is being spoken about. What? The risk control measures. Specifically, if it's a loss reduction, what specific action should we take? Another example, you are in the organization and then the manager realized that the employees were stealing A4 sheets, stealing staplers. He buys staplers today, the next day is gone. He buys this today, the next day is gone. Right? So now let's analyze it. The loss exposure is what? Theft. The loss exposure of what the scenario I'm giving is what? Theft. Theft is the loss exposure. So loss exposure is what? Theft. They steal in the organization. Watch. If they steal in the organization, the next question is this. If they are stealing in the organization, now let's analyze it. What is the frequency of the stealing? Is it high or low? It is high. What is the severity? If you steal an A4 sheet or some bundles of A4 sheets, it's not any serious, it doesn't have any serious impact. If you steal a stapler, how much is a stapler? So the frequency is high. What will be the severity level? High or low?
Low.
Very good. Low. So if you remember the matrix, right, or the mapping, if the frequency is high and the severity is low, what technique do we go for? It should be in the third quadrant. What technique is that?
Reduction.
Loss reduction. So pay attention. So loss reduction is the particular or specific technique to be adopted. Loss reduction. So this is the technique. But what specific action should they take or should be taken or should be implemented or should be adopted under loss reduction to ensure the frequency of the theft loss exposure is reduced? What specific? Because you cannot avoid employee stealing or pilfering, right? You cannot prevent it. You cannot prevent it, never. But you can control it. But in the case where the theft is so high in the department or in other department, but the severity is low because they don't have any bigger impact or any greater impact on the finance of the organization. So the severity is low. And we are saying that we have to reduce it. What is loss reduction? Loss reduction. No, it's not loss reduction. It's not loss reduction.
Yes,
Look at the quadrant. Watch. The frequency is high. The severity is low. It's loss prevention, right? Are you good?
Yes.
So the specific technique is loss prevention. So if it's loss prevention, what specific action under loss prevention should we adopt? That is the implementation part. Should we adopt to handle the theft loss exposure? Who can give me a suggestion?
Let's come again.
The frequency of the theft loss exposure in the organization is high. It is not severe because they don't steal photocopiers away. They don't steal computers away. What they steal are like A4 sheets, they steal staplers, they steal pens. You see those items are what they steal. So the severity is low. So here, if we are saying loss prevention is a technique, what specific action should be taken under loss prevention to control the theft loss exposure in the organization, in the department, or in the organization? What will you say? Who can help? Hey, I should be ending the time. Yes, who can help? Anyone. Let's be quick. Ima?
Sir, can you install CCTV cameras?
Good. You install CCTV camera. Very good, Ima. Thanks. You install what? Installation of what? Installation. I've used the exponent n to mean shen. Installation of what? CCTV camera. So now the frequency of the theft is so high. Come again.
Sir, alarm system.
And when it's still, it will blow.
Yeah.
Really? Okay, that's fine. Okay, so it's okay. But let's go with installation of CCTV camera. There's a specific measure. Right? So under the loss prevention technique, a specific action to be taken is what? Installation of CCTV camera. So that's what the business is going to implement to handle that theft loss exposure. So the frequency is high, the severity is low. That's the analysis we've gotten to or we've concluded on. Now, if the business implements installation of CCTV camera as a technique, as an action under the loss prevention technique, what will happen? What will be the effect? What will be the impact? The impact is the monitoring. We are going to monitor whether it will bear fruit, whether it will be able to meet our objective. Right? The business cannot prevent employee stealing, but they can minimize it. That's the loss prevention. Loss prevention is what? The reduction of the frequency of, or the minimizing of the frequency of a loss exposure. So the frequency is so high, you cannot say I'm preventing theft, whether small or big in the organization. But then you can minimize it. The rate can reduce. So if the rate can reduce, go with a loss prevention technique. What specific action and the loss prevention are you going to implement? It's installation of CCTV camera. So the business moves into install CCTV cameras. Then they will start monitoring. So the SIM, the ISM, the IM, you start monitoring whether you need to achieve your objective. Are we good? So when the CCTV camera is installed, or when the CCTV cameras are installed, do you think it will reduce the frequency of the theft? I'm asking a question. Do you think it will reduce the frequency of the theft? Yes, it will.
Yes.
So installation of the CCTV camera is a specific action under the loss prevention technique, which the business will adopt to implementation, IASM implementation. And after they implement it, they will monitoring. They would observe, right? They'll be measuring to see whether upon the subsequent or the pursuant to the installation of the CCTV camera, the frequency of the theft has reduced. If it reduced, then they will go again, analyze it again, the loss exposure, maybe it's not that. Now they will analyze it again, identify it again, analyze it again, select another technique. Then they will adopt another strategy, which might be more technical than the CCTV camera. Are we okay? Are we good? All right, we are done with this. Let me bring the weekend question. That's the last. You guys, you've taken about 3 hours of my time. You know how much people pay when I teach? It's taking so much of my time. But I think taxation, we might meet face to face with taxation. So let's see what we'll do. You have to come early. I'm just going to teach you strategies to go and answer the question. That's all. I'm going to teach you strategies. Where's your question? I'm going to teach you strategies to answer the question. Hold on. Good. It's here. This is the last question, then we close. So let's see. Okay. So look at that compulsory question. Yes, someone should read for us. Quick. Let me end. Quickly.
Sir, please, it's not clear.
Sir, we can't see.
Oh, is it because it's dark?
It's very clear.
Sir Manuel, please, I can't see.
So it is blurred.
I know, they've told me. I know, they've told me. Is it okay?
Yes, please, it's okay.
Okay. So, Nanele, read for me.
Sir, please, the second one is covering, is on top of it, so I can't see everything.
Wait.
I should read question 2 for you.
Question one. Can't you see question 1?
I
Yeah,
can
it's a
see it, but
corporate
then it's
governance question.
partly.
It's a corporate
Hey,
governance question.
Yeah, it's corporate
Yeah.
governance.
Yeah, read.
sorry. Okay, then which documents? Wait till. So who has the questions? Send it to me right now. Let me upload it.
Titus.
Sir, please, what question?
There are risk management questions.
Is it a weekend student?
Hold on. All right, mute yourself. So let's continue. All right, someone should read it for me. Question 1.
Question 1. Discuss the importance of reinsurance in the insurance industry. What are the benefits and challenges associated with reinsurance?
So how do you approach this question? It's simple. This just what they wrote 2025 when December, right? So it's 10 marks. The first strategy you adopt. Let me use red so I can be very visible. What you do first is to explain reinsurance. Discuss the importance. Explain reinsurance. You talk about the types. You did yesterday, the treaty, the facultative. Then you talk about how important it is for an organization, right? If you understand the concept, the importance must flow. Why do you think an insurer, a primary insurer, will transfer losses to another insurance company, which is a reinsurer? Why? That's what they are telling you to do. So that's where the importance is. So for you to get a 10 marks, you have to first explain what reinsurance is. You have to write about the parties, like tell us about reinsurance and why it is important, right? Tell the examiner about reinsurance and why it is important. Write all you know about reinsurance. The process of reinsurance, the costs involved in the reinsurance cost session. It involves a treaty agreement. Then you talk about the importance of treaty agreement, the facultative case-by-case transfer of losses from the primary insurer to the reinsurer. Tell us about what you know. That's what they mean. The benefits. B, examine the concept of moral hazard in insurance. We did it yesterday. How can insurance mitigate the risk? I did the word moral hazard. So it's simple. You know it. So what is moral hazard? Right? The defect in character, right? To increase the chance of a loss. Then 10 marks. So you just talk about first starts with hazards. Tell about moral hazard. Then, so let me see whether you can get the link. What can you link moral hazards to? What can you link moral hazards? You can link them to the legal principles of insurance. So how can insurance mitigate the risk associated with moral hazard? You come in with insurance. They are just talking about the legal principles of insurance. Subrogation, indemnity, right? Subrogation, indemnity, sui, utmost, right?
Utmost
Insurable
good faith.
interest. So that's all that they're asking you to do. But because you must show that you understand the concept. That's the whole thing. If you understand it, this one I know a lot of people feel. But those we did it with, and I told them the strategies, you should be able to solve it. I told you that there is one item common amongst all the 4 legal principles of insurance. It is moral hazard. They are all to reduce moral hazard. So how can insurance reduce the risk associated with what? Moral hazard. Legal principle of insurance. There must be utmost good faith during the insurance contract. There must be the principle of subrogation. The insurers must adopt the principle of subrogation, the principle of indemnity. Then you explain all of them. It's 10 marks, so don't mess up. Very good. It's 10 marks. You take the principle, you explain, you link it to moral hazard, right? So we first define hazard, define moral hazard, then you can give examples. Then how can insurers mitigate? They are just talking about, is there linked to the legal principle? You know it. But like, I couldn't do it because you don't want to understand the concept or you don't get to understand it. That's why when we're doing it, please mute yourself. I'm recording the session. Mute yourself. So when doing it yesterday, I told you there is something common, one term common amongst one action common amongst all the 4 to reduce moral hazard. That's to reduce it or to mitigate it. You cannot prevent it that the people should not be corrupt. You cannot say, you cannot tell people not to be corrupt. People will be corrupt. But there's a way you can reduce it. Not like what we were trying to see, what happened corruption in government and national service, they are so huge. You can steal, but not as much as 2.4 billion Ghana cedis. Not as much as buying one watch for $1.5 million or 1.5 million Ghana. One watch. A government, a civil servant, government, you see, no one say don't steal, but I cannot steal such a quantum of money. Only one person. So how do you reduce it? All right, let's continue. So let's continue. Look at the question 2. Efia applies for a motor insurance policy but fails to disclose that she previously had a license. She failed to disclose. What comes to mind?
Atmos good.
Hey. Very good. She fails to disclose that she previously had a license suspended. After an accident, the insurer refuses to pay. After an
material facts.
Okay. Analyze the legal implications of non-disclosure. Non-disclosure means what? Utmost good. They just changed the term. Non-disclosure is utmost good. When you fail to release, when you fail to disclose the details, the fact of the matter, the material fact, right? In all honesty, you breach the principle of utmost good faith. Advice. So analyze the legal implications of non-disclosure. They are just simply saying, tell us about utmost good faith. But here, link it to the case study. It's 10 marks. Advise whether the insurer is justified in refusing to pay for the liability. Is the insurer justified? In other words, the decision of the insurer not to pay the liability, to pay for the loss which has been suffered or sustained, is it appropriate or proper on behalf of or on the part of the insurer? 10 marks. You write on principles to solve the case. You link it to the case. You write, you solve it, you link it to the case. That's all. B. Kofi's insured warehouse is damaged by a fire caused by a negligent electrical contractor. It's past question. It's just like the other one, the one we solved today for last year. The insurer pays the claim and seeks to sue the contractor. Explain the legal basis for this action. Discuss the limitations of the insurer's rights. So what concept comes to mind?
Subrogation.
Subrogation, very well. So just if I were you, I just write subrogation, write all the tentacles of subrogation. Then I need to solve this question. So you can write and get 10 marks. You can write and not get 10 marks. And it's very, very easy. It's coming from the same thing. It's very easy. Question 3. The Senate Pension Scheme provides several major benefits. Explain each of the following: retirement benefits, survival benefits, disability benefits. This one, they are also easy. But if you are not sure, don't tackle them before you will get lesser marks. A drunk driver ran a red light and smashed into Christine's car. The cost to repair the car is 8,000. She has a collision insurance on her car with a 500 cedis deductible. Explain how the principle of subrogation would be relevant in the preceding case. Okay. Explain how subrogation is about the principle of indemnity. You can also tackle it. It's simple. It's not difficult. Okay, let's look at the next question. It's not difficult. So this will be my last, and I'll go away. All right, I have a lot to do. Can you all see the screen?
Yes, sir.
All right.
Yes, sir.
I've told you that there is a question. I can always tell you 100% sure it will come. And what question is that? Risk management process. Every time they will bring it. This one. Every year. Regular evening, every year. Because there are so many ways you can ask the questions on it. There are so many questions you can ask there. Those who haven't paid, when we are done, you have to pay. Be honest and pay. Because for my time alone, hold on, let me.
They have to subscribe.
All right. Describe the steps in the risk management process. Who can tell us? Raise your hand. Who can tell us the acronym for the risk management process? Who can tell us the acronym? Quick. Acronym. Raise your hand. IASM. Hey, IASM. Don't forget it. IASM. So are we taking you guys from taxation? You have to.
We'll be happy. Sir, we'll be happy.
If you
So
pay
what about
me just because.
marketing
Sir, how
management?
much?
All right. So this is describe the steps in the risk management process. 10 marks. Describe. So when you pick the way I wrote it for you, when you pick identification, you speak on the types, the PPL, people, property, personal liability, and there's kind of then you speak on each of them. Then you go to the sources or methods: investigation, inspection, balance sheet, interviews, right, checklists, reports. Then that's the first step. You go to the second step: analysis of the loss exposure. How do you analyze? You analyze the frequency and the severity, the high and low. Then you go on down to the selection of the risk management technique. You can write on the loss control, risk controls. What are they? The PARI, loss prevention, loss retention, loss reduction, loss avoidance, and insurance. Then you explain them. Then you can go to implementation. That specific, after the appropriate technique has been adopted, specific measures or actions under the techniques are adopted and implemented. Then they are monitored. They are monitored after the implementation of the specific actions, like the installation of the CCTV camera and the loss prevention has been adopted. Management must observe, management must monitor, management must ensure that specific technique is able to meet the specific objective, the specific risk objective of the organization. Are we good? Are we good?
No, so I'm a bit confused.
Are we good? Hello, are we good?
Say I'm a bit confused.
Where? Be quick. Where?
Yeah, you were talking about the techniques, and I didn't really get you clearly. That's why.
Were you here when I did the techniques?
Yeah, I was here.
Gordon, were you here when I did the techniques?
Yes, please. Yes, please.
Are you sure?
Yes, sir.
So give me one technique.
This guy,
Avoidance. You have avoidance.
Okay, so where didn't you understand? Where didn't you understand?
No, I understand all the techniques, but you were saying something which I don't really get in the
Where?
The place that you circle.
Oh, it's a risk management process. And I'm saying you use this acronym for the risk management process.
Oh, okay.
Are you good?
Yes,
so these are the steps. These are the steps for the process. The process is you move from one stage to the second, to the third, to the fourth, to the fifth, right? So you move from stage one. This is the I, A, S, and 4 and 5. The 4 and 5, we don't have 5, but you can say 4 is I, and the S, the 5 is what? Monitoring. So it's a process. It's a process. So that's what you're going to speak on here. And I've done it with you guys. You have the notes, so just go through it. All right. Let's move on. Let me finish. My time is up. For each of the following risk management techniques, you hear what she said? The question said, each of the following risk management techniques. They could say methods. They could say techniques. Your voice is very low. Come up with your voice. You can't see the question.
Yeah.
If you can't see the question, I said you leave and you join. You see it because others can see it. So it means that it might be your network or your screen. So you just leave the session and you join back. So here, for each of the following risk management techniques, describe a specific action. Good. That's what I told you about. Loss prevention is a technique. What is a specific action? Installation of CCTV camera. Using the technique that may help deal with the company's product liability exposure. So it's from the case study. So when you go to avoidance, read the case study very well. Then if it's a loss avoidance, what specific action should a business undertake? You might say the business should should cease producing this particular product. That is avoidance. The business should avoidance means you abandon the loss exposure. You abandon it. You get rid of it. Like you abandon it. You stop using it. I get it. So if you read the case study and you look at the product loss exposure or the liability loss exposure in the, have you seen it? Liability loss exposure in the case study. Avoidance means the business should abandon it. So he said they should list a specific action, just one. So avoidance simply, it goes with abandonment of the loss exposure. Just abandon it. Stop. Just get rid of it. Not get rid of it, like avoid it. Let it be there no more. I get it. Or redirect it or relocate to another source or relocate to another venue where there's no such loss exposure and be there and continue your operations. Loss prevention. What was the specific action we talked about? The installation of CCTV. That is, we are on the implementation stage. Specific action is implementation. Loss reduction. What should be done? What is loss reduction? It is the reduction or the minimizing or the mitigating of the severity of the loss after it has occurred. You are just reducing the highness. You are reducing from high to low. You are mitigating it. You are reducing it. So which specific action should they take? Loss reduction. Non-insurance transfers. I've told you about non-insurance transfer. You lease, you hedge. Right? You lease, you hedge. So when you read a case study, you can easily identify that this transfer of the loss they are talking about, it's not about insurance, but they are transferring the loss to another party. Right? There is hedging, there is leasing, and there are other types. I get it. So this insurance, this transfer they are talking about, it has nothing to do with insurance, because insurance is what? You are transferring a financial loss to somebody to cater for you. But non-insurance transfer, you are transferring a loss which has nothing to do with finances. But someone will bear the loss for you. The person is not going to pay you, but the person will bear the loss for you. It's a non-insurance transfer. Are you good? Class, are we good?
But since the question is for 10 marks, will we have to explain like the technique, what it is?
Yeah, you have to. You have to. When you write the technique, then you tell why the technique should be undertaken. And don't forget, in explaining the technique to be undertaken, you link it to the case study. You link it to the case study, because these questions were asked based on the scenario of the case study. So whatever technique you write, you have to be able to link it to the case study to solve a problem. That's why most of them say that immediately after your school, you should be able to start businesses. Not go and do shipping, online shipping, which is called drop shipping, and China shipping, to Turkey, Istanbul. No, that's not the kind of. It's a good business, but they want a business where you can be a manager. That's why in some organizations or some people, if you are out of school, they can hire you as a manager because they believe you understand the concept. I guess in it, you should understand the concept. All right. So here you are using the principles to solve issues, specific issues affecting an organization. All right. So I'll bring the end of the class here. Let me end the session.